Hey everyone, welcome back to Corporate Decoder. Today, AWP just filed a supplement to its prospectus, and I am seeing a significant change in how they handle expenses. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing updates how the fund limits its operating costs, and it could mean shareholders see more of their money going towards expenses. Alright, so let's dive into what abrdn Global Premier Properties Fund, ticker AWP, has updated in their latest filing. This isn't a brand new offering, but rather an update to their existing prospectus, basically like adding a footnote with some new rules. The big story here is a change in their expense limitation agreement, which is super important for anyone holding or considering holding shares in this fund. Think of an expense limitation agreement like a promise from the fund managers to keep certain costs below a specific percentage of the fund's assets. This helps investors know that a predictable chunk of their money goes back into the fund's investments and not just into operational overhead. Well, abrdn Global Premier Properties Fund has just updated this agreement. The key change, effective July 1st, 2026, is that the compensation paid to their independent trustees, who are essentially the folks overseeing the fund, will now be excluded from this expense limit. So, what does this mean in practice? Let's look at the numbers. Before this change, the fund had a contractual agreement to limit total operating expenses, excluding some specific items, to 1.40% of the fund's average daily net assets. Now, with the independent trustees' compensation taken out of that calculation, it means the actual expenses could tick up. The filing details that the advisory fee itself is set at an annual rate of 1.0% of the fund's managed assets. This is a standard fee for asset managers, but it is important to remember this is just one piece of the puzzle. Then there are the interest expenses on bank borrowings. The fund uses leverage, meaning they borrow money to invest more. As of April 2026, they had about $42.9 million in borrowings, which was around 10.4% of their managed assets. The average interest rate on this borrowing was 4.78%. This is a pretty significant chunk of expenses. And using leverage can be a double-edged sword. It can amplify returns when things go well, but it also magnifies losses when they don't. The fund does mention they might increase their borrowing up to 33.33% of their total assets, which would definitely increase these interest expenses. And under other expenses, they specifically call out that compensation for their independent trustees is included here. And as we just discussed, it is now excluded from the overall expense limitation. With this exclusion, the other expenses category itself shows a percentage of 0.31% of net assets. Prior to this change, this 0.02% that goes to the trustees would have been capped under that 1.40% limit, but now it is outside of it. So when you add it all up, the total annual expenses are listed at 1.80% of net assets attributable to common shares. While the filing states they've restated the expense information to reflect current fees after this amendment, it is crucial for investors to understand that this exclusion of trustee compensation means the fund's actual operating expenses could potentially be higher than what they were before this change. This 1.80% is the number they are reporting now, and anything above the 1.40% limit is now effectively permissible without the advisor having to step in and waive fees or reimburse expenses. Beyond these annual expenses, there are also transaction fees, especially if you are using their dividend reinvestment and optional cash purchase plan. For example, there is a fee of 0.02 per S-share for open market purchases made as part of dividend reinvestment. For optional share purchases, you could see fees like $5 for automatic debits from a bank account. And selling shares held in a dividend reinvestment account comes with a 0.12 per S-share fee plus a potential $25 charge for market orders. These might sound small, but they can add up, especially for smaller investors or those who trade frequently within the plan. Now, to put this into perspective, let's look at their example of expenses. For a hypothetical $1,000 investment assuming a 5% annual return, the example shows shareholders would pay $32 in the first year, $70 over 3 years, $110 over 5 years, and $223 over 10 years. This example, importantly, does not include sales loads or estimated offering costs, and it assumes the expense percentages remain constant, which, after this change, might not be the case. The filing explicitly states that this expense example should not be considered a representation of future expenses or rate of return. Actual expenses could be higher or lower. This is a standard disclaimer, but it is particularly relevant here because of the change in the expense limitation agreement. What this really means is that the advisor, the company managing the fund's assets, has agreed to limit total operating expenses to 1.40% per year, excluding things like leverage costs, taxes, brokerage commissions, and now, importantly, the compensation of the independent trustees. This contractual limit is in place until October 2027, but it can be terminated earlier with the approval of the independent trustees. The fund can also repay any waivers or reimbursements made by the advisor within 3 years, as long as it doesn't push them over the expense limit. Looking at the broader context, AWP Global Premier Properties Fund currently has a market cap of about $364 million and a P/E ratio of 56.6. This high P/E suggests investors have high expectations for future earnings, or it could indicate the stock is potentially overvalued. Recent news also shows they've had a 1-for-3 reverse stock split back in January 2026, which is often done to increase the share price, and they also announced a monthly distribution. Institutional holders like Morgan Stanley and Wells Fargo are invested, which can sometimes lend a sense of stability, but it doesn't negate the impact of increased expenses on shareholder returns. The core of this filing is a subtle but significant shift in how fund expenses are managed. By excluding the compensation of the fund's trustees from the expense limitation, the fund now has more flexibility to incur higher operating costs. For investors, this translates to a potentially smaller portion of their returns making it into their pockets. While the stated total annual expenses are 1.80%, the exclusion means that the advisor is not obligated to cap costs at 1.40% if trustee compensation pushes it higher. This is a key factor to watch. What I'm watching for is how this exclusion actually impacts the other expenses line item over time. Will the trustee compensation push the total other expenses significantly higher than the current 0.31%? It is hard to say without knowing the exact compensation. But the fact that they've made this change suggests it is an amount they anticipate not wanting to absorb under the previous limitation. My biggest concern is that this could be a precursor to larger expense increases down the line, subtly eroding shareholder returns over the long term. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives related to financial documents.